Okay, so today we're going to start talking about Chapter 4 in Financial Reporting and Analysis. Our goals for this chapter are to describe financial reporting and identify both qualitative and quantitative characteristics, as well as ethical considerations associated with financial reporting. We're going to define conventions of the conventions of consistency, full disclosure, materiality, conservatism, and cost benefit. We're going to identify and describe the components of the classified balance sheet. We're also going to discuss the features of the multi-step versus the single-step income statement. And we're going to start learning about the financial ratios that we're going to use to help us and support our financial analysis that we're going to be getting into with our companies that we're going to be analyzing this year. So let's talk about our objective number 1. Looking at our financial reporting, qualitative and quantitative characteristics, as well as some of those conventions and ethical considerations. So, we've talked about FASB in the past. FASB is a Financial Accounting Standards Board, and it basically states all the things that are necessary in financial information and reporting to make that financial reporting useful for the end users and those that are providing capital to a corporation. So, the two basic objectives of financial reporting are to help people be able to assess the cash flow associated with a company. And when we're talking about cash flow, we basically need to know what's available for that company. When is cash going to be available? And we want to make sure that we know when the cash is going to be available so that we can help the company to maintain positive cash flow, or what we call liquidity. Last chapter, if you remember, we talked about and tried to assess when is the inflow and when is the outflow. We were looking at that during that chapter. It's really important for businesses to understand that. Not only understand the timing of it, but actually where is their cash flow coming to. If you remember, we talked a little bit about things like, okay, if you have an increase in their debt, is that a source of cash or a use of cash? I tried to get you to understand that it's a source of cash when their debt increases. But you also have to counter that with making sure that the business doesn't take on too much debt. And so that's where later in this chapter we'll start to get into the ratios, because it's a fine balance between understanding that need for the cash flow and the timing associated with the cash flow, and then taking on more of a financial burden than the company can handle. And then we're going to look at assessing what we call management stewardship of the business resources of a company. So what we mean by stewardship is that we're essentially trying to make sure, as the organization's management, they've got a responsibility to both investors and creditors to manage the assets of the business to ensure that the business is going to continue as a going concern, that they continue to be profitable, that they continue to be liquid. So they have to guard the assets of that business as if they were their own, and then some, if you will, because they're trying to manage them for us, the investor, or for somebody who's lending to that organization. If management doesn't manage or steward, they call it. Steward is guarding them, managing them in a proper fashion. If they don't do a good job of managing them, us as investors, we could lose money, and creditors may not get repaid. Okay, so that's why those people that are in charge of managing the business are so important to us, the investors and the creditors. Okay, so in terms of the management, they have to be able to assess the position of and the relative liabilities to equities positions of the business. We also want to know if the business is profitable as well as being liquid. Pardon me. So that's what's really important about the stewardship piece. So some factors affecting useful financial reporting are what we call both qualitative and quantitative. Let's look at qualitative components first. So, qualitative characteristics. First, from a qualitative standpoint, the information that is being provided has to be useful to decision makers in helping them to make their decisions. In terms of usefulness, it has to be what we call relevant and a faithful representation and provide complementary qualities relative to the business. Then we have to also provide or follow along with our accounting conventions. We've talked about our accounting conventions previously, like all year long, we talk about our accounting conventions, okay? We're going to get into those more specifics in just a minute, so I'm not going to go into this one in great detail right now. But the factors of useful reporting is that they have to follow the accounting conventions. They have to, prepare the financial statements in accordance with whatever accounting conventions apply to that organization. And then lastly, they have to act in an ethical fashion. The CEO, the CFO, nowadays they have to certify the financial statements personally. In the past, there was maybe a little bit of a conflict. The CEO, the CFO, at the time, like say when WorldCom took place or Enron took place, those CEOs, CFOs, they didn't have to personally certify and say that those financial statements followed the accounting conventions. Okay, now they have to. So that means that they can not only be liable from a corporate standpoint, but they can be personally liable. So if they act in an unethical fashion and it's found to be that they were literally fraudulent, then their financial well-being could be on the line, as well as any criminal, they could have criminal liability as well. So they have to basically certify that they're accurate, they're complete, and they're not misleading. So some factors that affect financial reporting. This is a little bit of a challenging chart to see, but I'm going to break it down on the following slides. But on the left-hand side, the objective basically of financial reporting is to ensure that we have proper cash flow and that we have profitability, okay? And that we're guarding the assets of a business in an appropriate fashion through our stewardship. To that end, we have to follow the qualitative characteristics, we have to follow the accounting conventions, and we have to act in an ethical fashion. Those are the three items that go into providing objective financial reporting. Let's look at the first piece on the left, the qualitative characteristics. Okay. In the qualitative characteristics, we basically want that the information provides us with they're providing us with useful information. The accountants provide useful information. Has to be relevant, and in terms of relevant, it has to provide some sort of predictive value. What we mean by predictive value is not that they're necessarily your past performance, tells you exactly what's going to happen in the future, but it's going to give you some sort of inclination as to how the company is going to operate, what they're going to do, etc. In addition, it's going to confirm how they already done. Okay, so that's two things with relevance. It has to provide a faithful representation, meaning that the information is complete, it's neutral, it's relatively error-free. It's not that mistakes can't be made, but they're not necessarily material mistakes. And then, in terms of complementary qualities, the information has to be comparable, verifiable, in a timely fashion, and understandable. So if you remember when we started talking about our financial statement spreadsheets and our project with our financial statements, I had said to you, I went through that whole exhaustive explanation about why I want you to use the most current financial statements to gather the data from the previous year. Okay, so like for 2016, we'll go to the 2017 numbers. And part of that was, I had said to you that companies will sometimes update their numbers to help with that comparability thing. Because maybe something changed. Maybe how they accounted for something changed. Maybe a financial convention changed. Maybe a FASB pronouncement changed. Something might have changed in 2017 that affects 2016 numbers. So therefore, they had to update it. So they'll make it comparable. So that's part of the financial statement reporting that the company's management has to do. They have to make sure it's comparable. They have to make sure it's verifiable, meaning it's accurate, the information can be substantiated, and then timely reported in an appropriate time frame. So like I told you, if their fiscal year end was December 31st, we should all be basically being able to get our financial statements by now, because mostly the companies have to issue their financial statements by the 15th of March if their fiscal year end was December 31st. And then understandable is that it can be, it's meaningful and the information is understandable. The basic definitions of what things are, an account payable, etc. There's not ambiguity associated with what you're including in your accounts payable or in your accounts receivable, etc. We're not going to go and do this stop and apply right now. Okay, I'm going to bypass that. Let's move on to objective number 2, which is defining the accounting conventions and discuss what these accounting conventions are. So first, we have 5 accounting conventions that help us to ensure we understand that financial information. So the first one is consistency. Basically, consistency increases the usefulness of our accounting information because it ensures that we can see the changes clearly. We're going to use the same procedures from one period to the next, and if we change those procedures, we're going to note that in the financial statement footnotes. This allows us to make sure that we can compare financial information from one period to the next and ensure that we're looking at relatively the same types of information. It can also help us when we're trying to compare similar companies. So if we look at a Target and we look at a Walmart, we know that they're relatively similar, and we can try to make sure that we can compare them because they're doing the same types of things and hopefully are following the same types of accounting conventions. Full disclosure. We're going to make sure that we're reporting everything that we're supposed to report and that it's relevant. And basically, with regard to full disclosure, this is a lot of where we put in, and you can note on here, a lot of the clarification of the information relating to full disclosure. I see we're really well paginated here. Right? Oh my goodness. Full disclosure. How about you guys just write in here? This is where the footnotes to the financial statements go in. Play a big part in the full disclosure. The footnotes to the financial statements play a big part in full disclosure. They're going to explain things that would otherwise not be easily understood. So for instance, if there's anything that's quirky or any specific details, in particular things like liabilities, where there's lots of different types of liabilities, there's going to be footnotes that explain the different types of liabilities and the different types of debt that that business might owe. Then we have materiality. This is making sure that any items that are of a significant dollar value impact to the company are noted in the financial statements and explained, if need be, in the footnotes. A typical rule of thumb is that if there's a 5% or more impact on net income, that it's something that should be identified, and the change in the value might affect the decisions that people might make. That's considered typically a material item. Concept of conservatism is we want to make sure that we don't overstate our assets. So if you remember last chapter, one of the exercises that I had you guys do was to think about, did that whatever item or entry overstate, understate, or not affect your assets? That's a really important concept for you to understand in terms of conservatism, because we want to make sure that our businesses are fairly reporting their financial information and being conservative. We've talked about that, conservative. You don't want to overstate the value of your business. And then lastly, cost benefit. This is ensuring that whatever you do within your business, that you're going to gain more than it costs you. So in other words, if a business is going to analyze the possibility of automating some process in their workflow, maybe they're going to put in a new machine. What they want to do is they want to assess the cost of that machine relative to the benefit that that machine is going to gain them. Am I going to spend $1 million on this machine, but it's going to save me $200,000 a year in labor costs or material waste or a combination of the two, so that over time that savings between labor, materials, maybe energy that it's using, etc., will in the long term offset the cost of that machine. Okay, so that's what cost benefit is about. Okay, and again, we're going to pass by these discussion points for the time being. Objective number 3, which is to look at the classified balance sheet. So, when we have a classified balance sheet, that's what we're working with this semester. Last semester, we worked with a very, very simple balance sheet. This semester, and on most of your companies that you're analyzing for your final projects, they're working with what we call a classified balance sheet. And if you look at, I think it's very important that you look at this. Look at page 205 in your textbooks. I'm going to pause this while you guys. So when we're looking at our classified balance sheet, we have our assets equal our liabilities plus our stockholders' equity. On our balance sheet, our information is going to be categorized into different subgroups. Our current assets are investments, property, plant, and equipment, and intangible assets on the asset side. On the liability side, it's going to be current liabilities and long-term liabilities, and then in stockholders' equity, it's going to be the contributed capital and the retained earnings. Let's look at this a little bit more. So on page 205, you can see our balance sheet for Martin Auto Parts, and you can see how they have the category called current assets. And then they have a subtotal for their current assets. We have this subtotal over here, also here on our snowboarding components balance sheet. We can see that we have a subtotal for these current assets. It's a total of all of these things. And then we have long-term assets, or long-term investments, which is going to be items such as long-term notes receivable, investments in stocks and bonds, land held for future expansion, and we have a subtotal for that. So our long-term investments goes below our current assets, because with our current assets, what's the deal we've always talked about with our current assets in the past? What's the thing here that's common about these current assets? What are we doing with them? Converting them, pardon me? Converting them to cash within a year or less. So we want to collect on our accounts receivable. We want to be able to sell our inventory. We're going to use up our prepaid expenses. Short-term investments, we can sell or liquidate our short-term investments in a quick period of time. Long-term investments, we might not collect on that note receivable until beyond a year. We might be planning to hold on to those stocks and bonds. We might be planning to hold on to that land, either to sell it in the long term or to use it for future expansion. And then we have our plant and equipment assets. And if you notice here, we have, with regard to our plant assets, we have our items at their cost, so equipment and buildings at their cost, less the accumulated depreciation, less the accumulated depreciation is going to give us our net, what do we call net? Book value of our equipment and buildings. Our land, do we depreciate the land? Do we depreciate the land? No. Usually this land is up top. I'm not really sure why they've classified it down here, but land is typically right at the top. And then we have our intangible assets. Okay, so let's look at these definitions here. So we have our current assets. Oh, there you go. Right. Okay. So current assets are items that we're going to convert to cash within a year. Our long-term investments are things that we're not going to be using in the operations of our business. And then we have our property, plant, and equipment, which is our fixed assets. They're tangible in nature. We can touch them. We can feel them. They depreciate. And within the property, plant, and equipment, we would also lump or categorize things such as natural resources. So like if we had a business, say like a mining business or a timbering business, okay, where they own trees or a forest someplace, those are considered natural resources, and they're going to do something called deplete, and we'll talk about that in later chapters. And then lastly, we have what are called our intangible assets. They have no physical substance, but they certainly have value to us. If I'm a singer or a songwriter and I create a song, is there a long-term value to me associated with my song? Certainly, of course there is, right? Certainly there is. But can I touch that song? Can I feel it? No, I can't. It's, pardon me?
Just in your heart.
Just in my heart, right, exactly. So it has a long-term value. If I'm a drug manufacturing company and I put a lot of time and energy into the development of some new drug, is there a value in the time and money that I've invested to create that new drug?
Yeah.
There absolutely is. So that's an intangible value. If I sell my business and I sell it for more than the assets values of the value of the assets that I own, is there an extra value to the person who has purchased that business beyond the cost of the assets? Sure there is. Okay, that's all intangible. You can't touch it or feel it, but there's a value to it. Also on the classified balance sheet are the liabilities on the other side. And we have our liabilities that we're going to repay within less than a year. Those are our current liabilities. So we would take all of our current liabilities, total them up, and get our total current liabilities. And then we have our long-term liabilities, things that we're going to repay within greater than a year. Let's think about this, though. If we have mortgages payable, let's say our mortgage is payable. Let's say we had a mortgage on this building, and the total amount is going to be paid over, say, 20 years or 30 years. 30 years. Let's use 30 years. Is there a portion that's going to be due this year? In the next 12 months, right? I got to make loan payments every single month, right? That portion that's due within this year of the total that's due over 30 years, the portion that's due this year gets included in the current liabilities. So that's this item here called current portion of long-term liabilities. So of the total amount of long-term liabilities, $150,000 in this example, a portion of that, $7,500, is due this year. So in actuality, their long-term liabilities right now, the outstanding balance would be $157,500. This $150,000 plus the $7,500. But of this, a portion is due this year. So we categorize that in the current portion. Then lastly, we have our stockholders' equity, which consists of our common stock or contributed stock, contributed capital, which is the par value of our stock, plus any paid in excess of par. We talked very briefly about that in Chapter 1. We will talk about that again as we progress through these chapters. And then we have our retained earnings. Our retained earnings where we accumulate our profits or losses for our business. The two together equal up to our total equity. And then our total equity plus our total liabilities equals the total liabilities plus equity. This is really important for you to understand because when you go to do your spreadsheets, you need to make sure you're not leaving out any of these individual items and that you're lumping the items into the appropriate classifications on your classified balance sheets. Your spreadsheets are all classified balance sheets, okay? They're all classified balance sheets. Okay, and obviously this is different from a sole proprietorship where we had one capital account. Or a partnership that has two or more. If you have multiple partners, you would have multiple capital accounts. And that's it for our notes for today. And that kind of covers that question. Alrighty, let's pause or stop.